Welcome back to our Trading for Beginners course. If you have been following along, we have already covered the foundations, support, resistance, candlesticks, and trends. Now in this episode, we are taking a big step forward because we are entering the world of indicators. But here's the thing, there are dozens of indicators out there. RSI, MACD, Bollinger Bands, the list goes on. And for new traders, that can feel overwhelming. That's why today, we're going to focus on just one, the moving average. Now, you might be asking, why the moving average? Because it's one of the simplest yet most powerful tools you will ever learn. Almost every trader, from beginners to professionals, uses it in some way or the other. And the beauty of it is, it doesn't just give you numbers, it tells a story about the price action. In this video, we'll focus to break down exactly what a moving average is, why traders use it, the different types you will come across, and most importantly, how to actually use it in your own trading. By the end of this lesson, you'll be able to look at a chart and instantly spot the trend, potential areas of support and resistance, and even possible entry or exit points, just by using moving averages. So grab your notebook because this is where trading starts to get really exciting. Let's dive into moving averages, the indicator that every trader should know. What is a moving average? All right, let's slow it down and talk about one of the most important building blocks in trading, moving averages. Now, don't let the term scare you. It's actually very simple. A moving average is literally just the average of past prices over a certain number of candles. And the reason it's called moving is because as each new candle closes, the average shifts forward. So it's not static, it's constantly updating. Think of it as a way to clean up the messy chart you're looking at. Price is always wiggling up and down, but the moving average smooths that noise out and shows you the heartbeat of the market. Let me give you a super quick example. Imagine we are looking at the last 5 closing prices, and they are 10, 11, 12, 13, and 14. Add them all up, you get 60. Divide that by 5, and the average is 12. That's your 5-period SMA, or simple moving average. Now let's say a new candle comes up in and closes at 16. That means your last 5 numbers are now 11, 12, 13, 14, and 16. Add those up, 66. Divide by 5 and you get 13.2. Notice how the average moved higher as price moved higher, but it did it in a much smoother way than the raw price jump. That's the whole point. So that was the SMA, the simple moving average. It treats every candle equally. It's smooth but slower to react to sudden changes. Swing traders and even big institutions love using the 50 SMA or 200 SMA because they are widely respected as trend lines. Now let's talk about the EMA, or exponential moving average. This one is a little different. It gives more weight to recent prices, so it reacts quicker. Traders who want to catch momentum or find precise pullback entries often use the 9 EMA or the 20 EMA. For example, if yesterday's EMA was sitting at 12 and today's close jumps to 16, the EMA doesn't just inch up a little. It pulls itself closer, maybe up to around 13.3. It adjusts faster than the SMA, which is why it's so popular for timing entries. There's also something called WMA, weighted moving average. It's similar to the EMA in that it favors recent prices, but it does it in a more linear way. Newer candles get a heavier weight, older candles get lighter weight. So if we use that same set of numbers, 11, 12, 13, 14, and 16, the WMA would come around 14, which is even more responsive than the EMA. Not every trader uses this one, but it's good to know it exists. So let's wrap this up with a quick analogy. Picture a heart monitor, the kind you see in hospitals. The raw signal has all kinds of tiny spikes and dips, but underneath it all, there is a steady heartbeat. That's what a moving average is on your chart. It doesn't predict the next beat, but it lets you clearly see if the heart, your market, is healthy and trending, or weak and flat. Here's the quick takeaway. The SMA is slower, but very reliable, especially for spotting big picture trends. The EMA is faster, great for short-term trading and catching pullbacks. And the WMA, super responsive, but not as widely used. At the end of the day, moving averages help you filter out noise. spot the trend, and time your entries with more confidence. Bottom line, a moving average is a simple, powerful way to add context. It won't predict the future, but it will make the present much clearer. Now that you know what moving averages are, the real question is, why should we use them in trading? The stock market is noisy, prices go up and down every single second, and if you just stare at raw candlesticks, it can feel overwhelming. That's where moving averages come in. They smooth out all that noise and give you a clear picture of the overall direction. Think of it like this. Imagine you're driving on a bumpy road. Every bump is like a price fluctuation. But when you look farther down the road, you can clearly see whether it's heading uphill or downhill. That's exactly what moving averages do for traders. They help us see the road ahead without being distracted by every little bump. Another big reason to use moving averages is that they identify trend direction. If the moving average is sloping upward, it signals a bullish trend. Buyers are in control. If it's sloping downwards, that's a bearish trend. Sellers are in control. And when it's flat, the market is sideways, meaning there's no clear direction. But here's where it gets interesting. Moving averages can also act as dynamic support and resistance. Prices often bounce around these averages. For example, in an uptrend, a stock might pull back towards the 50-day moving average, find support there, and then continue higher. Traders across the world watch these levels, so they often become self-fulfilling. Everyone expects the bounce, so it happens. And that leads to the final reason. Moving averages are a universal trading tool. They are respected by retail traders, institutions, hedge funds, literally everyone. Whether you're looking at stocks, forex, crypto, or commodities, moving averages show up everywhere. So in short, they smooth the noise, they show you the trend, they act as support and resistance. And they are used by traders across all markets. That's why moving averages are one of the most powerful yet simple tools you will ever learn. Now let's talk about the real players when it comes to moving averages. The ones you will actually see traders use every single day. The 9 EMA is like the scalper's heartbeat. It's super fast, super reactive, and day traders love it. If you're looking at a 5-minute chart of a stock that's trending up, watch how price often pulls back just to the 9 EMA before bouncing higher. Traders use that as a quick buy the dip spot. Same for downtrends. Price often hugs the 9 EMA on the way down. The 20 EMA. This one is a favorite for swing traders. Think of it as a sweet spot between short-term noise and the bigger trend. On the daily charts, if a stock is trending up and pulls back to the 20 EMA, traders often look for bullish signals there, like strong candles or volume confirmation. It's basically an area of value where the market decides, are we continuing the trend or breaking it? Now we are getting into more medium-term territory. The 50-day SMA is one of those averages that almost every serious trader and institution has on their chart. Why? Because it often acts as a major support or resistance. Now, if a stock has been riding above its 50-day for months and suddenly closes below it, that's a big red flag. It can signal the trend is losing steam. On the flip side, if price bounces off the 50, traders see that as confirmation of strength. And then we have the king, the 200. This is the line in the sand. Institutions, hedge funds, fund managers, they all watch the 200. If the price is above it, they'll often call the market bullish. If it's below, they call it bearish. Think about the S&P 500. Whenever it dips below the 200-day moving average, headlines start popping up everywhere about bear markets or market corrections. That's how important it is. Now let's wrap up. Use the 9 EMA if you're focusing on intraday momentum. Use the 20 EMA for swing trading pullbacks. Keep the 50 SMA for medium-term support resistance checks, and never ignore the 200 SMA EMA. It's the institutional benchmark for long-term trends. Now that you know the most common moving averages, let's go deeper into how traders actually use them. Relative strength with MA. One powerful way to compare markets is by looking at where price sits relative to its moving average. If stock A is trading above the 50-day moving average, while stock B is trading below it, stock A is showing more strength. And here's the kicker. The further price is from the moving average, the stronger the momentum. But keep in mind, too far usually means it's overextended and could snap back. Timing entries with moving averages can happen when many beginners make the mistake of chasing prices after a big move. That's risky because price often pulls back. Instead, use the moving average as your area of value. For short-term trades, that could be the 20 EMA. For swing trades, the 50 SMA. When price pulls back to these levels, you get a much better entry, tighter stop loss, and improved risk to reward ratio. The 200-day moving average is like a compass. If price is above it, the big trend is up. Focus on longs. The price is below it, the big trend is down. Focus on shorts. But remember, always give more weight to price action and market structure. Moving averages are tools, not the boss. You have probably heard of the golden cross when the 50-day MA crosses above the 200-day. It's a bullish signal, but here's the truth. Crossovers work best in trending markets. In sideways, choppy conditions, they'll eat your account alive. So never rely on them alone. They lag behind price. Trend following and pullbacks. This is where moving average shine. When the moving average is sloping up, it tells you the trend is healthy. In a strong uptrend, you can use the 9 EMA or 20 EMA as a dynamic support, buying dips as price pulls back into that area. In downtrends, flip it, sell rallies into resistance. Trailing stop with MA. And finally, moving averages are great for staying in big moves. Instead of exiting too early, you can trail your stop loss behind an MA. For shorter term trades, use the 20 EMA. For medium term swings, the 50 SMA. And if you want to ride a huge long-term trend, you can trail behind the 200-day. There is no single best MA for trailing. It depends on whether you want smaller drawdowns or bigger trend captures. So to sum this up, moving averages aren't just lines on a chart. They give you structure, help time entries, and can even guide your exits, but only if you use them correctly in line with price action. Now that we have gone over how to use moving averages, it's really important to understand their strengths and weaknesses. Let's start with the strengths. First, moving averages are universal. Traders all over the world, whether they are in stocks, forex, crypto, or commodities, watch these levels. That makes them powerful, self-fulfilling tools. Second, they are super easy to understand. You don't need complicated formulas, just a line on the chart tells you the average price over time. Third, they are great for identifying trend direction, support, resistance, and pullback opportunities. And finally, they are flexible. You can apply them to any time frame, from a 1-minute chart to a monthly chart and across any market. But here's the other side, the weaknesses. Moving averages are lagging indicators. That means they follow price. They don't predict what's coming. They also don't work well in sideways or choppy markets. You'll often get false signals and whipsaws. Another issue is clutter. If you load up your chart with too many MAs, you will confuse yourself instead of finding clarity. And finally, moving averages are not a standalone tool. You need to combine them with price action and overall market context to get reliable trades. So think of moving averages as a powerful tool, but only when used correctly and in right conditions. Now that we have got a strong foundation of moving averages, let's take it one step further and combine them with price action. Because here's the truth, moving averages alone are not enough. If you just buy every time price touches the 20 EMA, you will win some trades, but you will also get chopped up in sideways market. That's why we use price action plus moving averages together. So how do we do this? First, look at the trend direction using your MAs. Is price moving above the 50 SMA and the 200 SMA? Then the bigger picture is bullish. Second, watch how price reacts when it pulls back to an MA. Don't just blindly buy. Instead, look for confirmation candles like bullish engulfing, hammer, or rejection wicks. Third, Check for market structure, higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. When you put these together, moving averages stop being just lines on the chart. They actually become a map for timing trades. So remember this formula. Trend plus MA is equal to direction. Price action at MA is the entry trigger. And here's the big takeaway. Moving averages don't predict, they guide. Price action gives the signal. Now that we have covered all the theory behind moving averages, let's actually put it into practice and add them to our charts using TradingView. Because let's be honest, knowing what an MA is won't help you unless you can actually use it while analyzing a market. So let's do it together. Step 1. Head over to TradingView.com and open up any chart. Could be a stock, forex pair, or crypto. Doesn't matter. The process is the same. Step 2. At the top of your screen, you will see the indicators button. Click that and in the search bar type moving average. Select moving average if you want an SMA or moving average exponential if you want an EMA. Boom, it's now on your chart. Step 3. By default, TradingView usually sets the length to 9 periods, but you can change this. Just hover over the indicator label on your chart. Hit the settings gear and type in the number you want. For example, set it to 9 EMA for short-term momentum, 20 EMA for swing trading pullbacks, 50 SMA for medium-term support and resistance, 200 SMA for the big picture trend. Step 4. You can change the color and thickness so you don't confuse them. For example, I like to make the 200 SMA bold and red because it's the most important, and maybe the 9 EMA in blue since it's short term. This way, at a glance, you know which line is which. Step 5. Now here's where it gets powerful. If price is above the 200 SMA and holding strong, the market is bullish. If it's below the 200, that's bearish. If it's just chopping back and forth around, the market is in consolidation. On a short-term chart, watch how price pulls back into the 9 or 20 EMA and either bounces, continuing the trend, or breaks, signaling a shift. This is exactly how traders time their entries. So the moving average isn't just a line, it's a map that tells you, are we trending up, are we trending down, or are we stuck in a sideways chop? With TradingView, adding and customizing moving averages is only a few clicks, but the insight they give you is massive. Now, every time you pull up a chart, you will instantly know the market's heartbeat. Combine with that price action and you will have a real edge. But here's the catch. In the free version of TradingView, you can only add 1 or 2 indicators at a time. That means if you want to run a 9 EMA, a 20 EMA, and a 200 SMA together, you will need to upgrade to a paid plan. But don't worry, there's another free alternative that gives you more flexibility. It's called stockcharts.com. And with their free charts, you can actually add up to 3 moving averages and 3 indicators without paying. Let me show you how. So let's quickly walk through how to set up your moving averages here. First, go to stockcharts.com. You don't even need to create an account to start using their free charts. Just type in any ticker symbol at the top. Let's say Apple, that is AAPL, and hit enter. That's going to bring up your stock chart. Now scroll a little bit down. You will see a section called Chart Attributes and Overlays. This is where we add our moving averages. By default, the chart is set to candlesticks, but you can adjust that if you want. What matters for us are the overlays. In the first overlay drop-down, select Simple Moving Averages and type in 20 for the length. That gives you your 20 SMA. Want to add another one? Easy. In the next overlay, select Simple Moving Average again, and this time type in 50. Now you have got your 50 SMA. Now let's go on more. In the third overlay, add a 200 SMA. Perfect. Now you have got the 3 most common moving averages that traders use, the 20, 50, and 200. If you want to add indicators like RSI or MACD, scroll down to the section called Indicators. Click the drop down, select RSI, and it will appear below your chart. Same thing for MACD or volume. Just pick them from the list. Now in just a few clicks, you can set up a professional looking chart with moving averages and indicators that traders around the world use every single day. So here's the bottom line. TradingView is more flexible, cleaner, and customizable, but the free plan limits you to 1 to 2 indicators. Stock Charts gives you 3 moving averages, 3 indicators free, which is more than enough for everything we are learning in this moving averages course. So whether you are on TradingView or Stock Charts, the tools are there. The key is learning to use them the right way. We have learned how the EMA smooth out price, how they guide us through trends, and how they can sharpen our entries. But remember, moving averages alone aren't the full picture. They're most powerful when you combine them with price action, support and resistance, and overall market context. And here's the big takeaway. Moving averages are our first step into indicators. We now understand how they smooth price, guide trend, and improve entries. In the next parts, we'll dive into other indicators like RSI and MACD, and we will see how they work together with moving averages for confirmation. So if you found value in this video, make sure you hit that like button, subscribe, and turn on the bell so you don't miss the next lessons. I'll see you in the next one, where we take this trading blueprint even further. Bye for now.